Let's get started. Again, my name's Steve Hodgden, and joining me on the other screen is Nick Curry, and we run Modern Asset Management, which is a small lending company in Laguna Hills, Southern California, and we finance all manner of things, including a pool of mortgages, a handful of real estate projects, and do some hard money lending here, and also do equity investing in spec builds and other types of things. And oh, hi, Wesley. Wesley says, hello, everyone. Hello, Wesley. I'm going to try to open this up to some questions. So what I'm going to do this evening is I'm going to run through Nick and I are going to run through three completely different types of deals that we're in, and talk about some of the pitfalls and problems that'll come up. I've been doing this kind of perspective because I've been attending real estate meetups and note conferences, and just am tired of everybody promising the sun and the moon and frankly, not being able to deliver. So I thought I'd share some real world stuff that we're working through, and hopefully that'll give us something to talk about.
So Steve, maybe just start it off. You've said what can go wrong will go wrong in the title of the presentation, and are we preparing for, well, you and I go in preparing for worst case scenario, but we've definitely had things go right. This will highlight things that have gone wrong, but our credo is always protecting the potential downside. Those remain true, and our experience from A to Z and a variety of different assets and projects with 8 digits and 4 digits. They're really what have been the fuel of our success. But
yeah, and to that point, the first deal that we're gonna talk about is a deal from another investor's perspective. Was a deal going wrong that we figured out is going to be really well. I hope it's not our home run for the year, but it sure looks like it's going to be. So like I said, what I did is I called it "What can go wrong will go wrong," because that's the nature of this beast. This is a project that we invested in a little over 2 years ago, and it looks like it's going to have a 26, 28 month curve from beginning to end. And so the biggest problem with this project was time. Just plain and simple time. We're 2 years into construction because it's in Los Angeles and permitting issues, and there was a change midstream. But we got into this deal at the very beginning in an equity investment in what I thought was a very favorable guaranteed return position. And the project, Nick's going to talk about the project in specific, but we found one of the equity partners wanted out, and we cashed them out and paid them a profit. And then we doubled down and lent a third to finance this project to conclusion. It's a 6,200 square foot, just magnificent little mansion on the top of a ridge in Bel Air. This view on the left, this is the entertaining floor, and this is, I don't know how many thousand square feet large. It's the middle floor of a 3-story project. That view out the back is the canyon, and then from the floor above, or 2 floors above, not the main floor, but the rooftop, this is the view looking the other direction, and out here in the distance is the city of Los Angeles and the Pacific Ocean. It is a premier project, and so this is the biggest residential project I've ever done. I've done a 50,000 square foot shopping center. But this is certainly, well, the biggest in terms of price per square foot. So let's see if we can get Nick on to, there you go. Nick, I'm going to unmute you, I think. How about you try to unmute you? Unmute audio. Yep, you're good.
Okay, great.
All right, and I'm going to mute me, and I'm going to let you talk for a little bit.
Yeah, a few things with Steve. If you wouldn't mind letting me share my screen. A couple other things to add on this deal. The investor that wanted equity investor that we were able to buy out opportunistically was a someone we solicited. We really felt comfortable about the deal, and there was a second position syndicate of 9 different investors that was it required being able to pull the transaction off. However, it ended up being a additional layer of complexion and confusion that really put a lot of pressure on the developer to be able to be transparent, and not everybody that was involved in that syndicate had knowledge all the time of what was going on in the transaction. And so here's an example. This is actually what the with taking out the names there. So deal structure, everybody invests into this second position lien. There's a 20% preferred return, minimum guaranteed, and then the greater of that, or 50% profit share on the back end sale of the asset. So the position that we took out was 20% premium 2 years later. So that $100,000 position was valued at $140,000 when we paid the investor $120,000 for their position 2 years later. So if that position continues to accrue until January 2019, it'll be worth about $150,000 with the minimum preferred return. So we're expecting the property to exceed the 20% minimum preferred return. But the lesson here is too many chefs in the kitchen, and simpler is better. And the development experience of having things go wrong and expecting worst case, not I guess worst case scenario, but knowing your risks and what you're up against, and making sure the permitting and the developer is experienced, but not only has the contractors ready to go, but has a working established relationship with them, which this one did, and it'll turn out to be very successful, and will be beautiful once it is staged next week, and listed for just under $8 million, I believe. So some interesting statistics as well on that local market. Let's see, make sure my screen changed over. So we had pulled some comps along with the just to kind of validate the local that market, which has very few transactions, but transactions of very massive size. You could see the we pulled out of 53 sales that have occurred in that Bel Air, Beverly Hills, Holmby Hills, General, 10 to maybe 20-mile circle. There were 53 transactions, and we pulled out 15 outliers. The average days on market here in cell D, 328 days in sales that occurred in 2017. Sales that have occurred in 2018, 75 days on market. So there's been a lot more transactions this year, which I found really interesting. Average sale price has been about the same, and the property that we're developing falls right within that that range, and also that square footage at about 6,000 square feet. So our 1,200 per square foot comps validate the new construction valuation that it was originally appraised at in 2016, which we feel like we're in even a better market now. So we look forward to sharing the details on the exit of that property as it continues to unravel over the next few months. So stay tuned.
All right. Nick, that was great. Thank you. Let's put myself back in here for a second. So this, again, this is, I'm going to show you transactions. I started with the crown jewel because us real estate folks love stuff that you see on TV. And I'm going to go down the ladder a little bit. I'm going to step down to a mid-range property, and then another mid. So I'm going to go to a B property, then a C property, and if there's time, I'll go to a D property, or maybe we'll just open it up for questions and see where we go from there. Nick, if you want to unshare or stop your share, and let's see, and I'll go back. So again, this was the picture of, this is, for those of you that are interested in looking this up, this is 1200 Linda Flora, Flora, in Los Angeles. I was standing on the roof when I took this picture, and up until then, I've been, thinking it was not something that was my cup of tea, but we're enjoying this. This is more my cup of tea. This is a house in Merrillville, Indiana, that we bought in foreclosure. The upper floor is 2,500 square feet. It's got a 1,500 square foot finished basement, so that was a lot of house to rehab. The things that have caused this problem, this to run over a year now, is time. Well, by definition, time being a year. We went out and got bids from contractors to rehab it. We didn't like any of those numbers. We tried to wholesale it. We didn't have any. We were too optimistic on price at the wholesaling level. I was trying to make $30,000, and I could have made 20, but I didn't take it, which is one of the rules I've learned, and I learned years ago. Is sometimes your first offer is your only offer. So this rubbed that back in. What I wound up doing is I partnered with a local, really experienced contractor, a guy who's done lots of work in inner city in Gary, building Section 8 rentals. He took on this project as an equity partner. I had gotten a couple of estimates for repair that were $90,000. And he took on an equity partner role and did all the work, provided all the materials for a $60,000 piece of the equity of the property. So this is it. It's a 2,500 square foot executive home in a neighborhood of executive homes, a mile from a private country club, in a part of the world that doesn't have giant factories and lots of executives anymore, right? So we didn't do, so the borrower owed $164,000. Those of you note folks will understand this. The borrower owed $164,000. I bought it from Condor in a pre-foreclosure. I bought it 3 weeks before foreclosure. I paid $110,000 for it. It had traded back in '08 for $175,000. We put it on the market at $249,000. We had an offer that we were in contract that fell through for financing at $235,000. It's being actively marketed by a trusted real estate professional that I've been working alongside for a couple of years. Dion DePaoli at SDXS happens to live very close to this property, which is one of the reasons we chose it. The sheer size of the property made for a long remodel. I'm used to getting in and out of my small fix and flips in Florida in 90, 120 days. There was water damage in the basement, which required a fair amount of work and led to, I don't have pictures of, a beautiful family room downstairs. So the deal terms with the contractor, he has a $60,000 equity position to cover his cost of materials, and he gets $50,000 over of anything that we have over $190,000 in a net sale, which is, call it $210,000. Where we've got lots of lookers, and I'm gonna guess that we close this at 2.25, 229, and I'll make what's that? I'll make 30 on it, but it will have taken 15, 16 months, and that's that's not that doesn't excite me. So, but again, solid piece of real estate. I could turn it into a rental; it would be just fine. But with the partner, I want to get in and out and go do something. Go do something else. This is a property that I bought 14 months ago. I bought a foreclosure. I bought a delinquent note and pushed it into foreclosure. And the borrower had a fair amount of education and real estate experience and had been fighting to stay in this house for years. Hadn't been paying, but he'd been fighting to stay in this house for years. There'd be some partial payments, there'd be a bankruptcy, there'd be all the games and delaying through the bankruptcy processes. In the midst of this, he got divorced. He has some sort of disability, I think related to time in the armed forces. He's in his late 60s. And I've talked to him several times. He's just mad. I mean, he is mad, and the world owes him this house. And we finally got to the point where we have an agreed sheriff eviction date of July 30th. He's got an extension cord going to his neighbor's house to keep the lights on. This is a better picture of what it looks like today. I just got. This is a letter from the township telling me that there's a weed abatement problem and that we have to go cut the grass. So I'm going to call them tomorrow, since that came today, and find out how much time I have and if that's been rectified. But anyway, the numbers. Excuse me. As I bought this loan for $78,000, I've got about $10,000 in costs in it so far. Probably a couple more to finish, so maybe 12,000. So that's $78,000, $88,000, $90,000 all in. I have a quick sale BPO of $125,000. So there's a spread in there and a little bit of room. It's going to need some work prior to REO. I'm sure he's not going to leave it broom swept and with everything functioning. I'm not sure what the exit's going to be. I'll get an REO estimate once we have the keys. I might fly out to Cincinnati and walk it and talk to local property management. to see if it's something to hold. I like the neighborhood. It's the smallest house in a neighborhood of nicer houses, so it may have prospects as a rental. Also, could sell it to a local investor and just go again. I think there's a smirk on Nick's face that it's just like that's the last thing I need. It's another project in Ohio. I've had 4, 5 there, and they've all had some sort of hair on them. I find well, folks are attracted to Ohio because of the remarkable cap rates, and you can buy houses for $5,000. It doesn't seem to be my game. I got excited standing on the roof of an $8 million house. I've been inside of houses that I bought for 25. No, I've been inside of a house I paid $13,000 for. I can tell you which one I'd like to live in. It's not the little one. But anyway, so the things that I learned in this is even with 30 years of debt collection experience, I can't move mountains. And certainly your servicer is not going to say or do the kinds of things that I can do in a conversation with a borrower, because they don't have the skills, they don't have the ability to walk along the edge of the rules. I offered this man his house. I offered him a deal that would have gotten us a return in the low teens, would have left him kept his house, helped clean up his credit. Maybe he got all kinds of ways, and it wasn't. It was not to be. It was not to be. So this project will be 18 months. I've bought the land, built a house, and sold the house in 4.5 months in Pensacola. And I like that so much, I did it again. And so that's that. I'm getting a little spoiled. I'm on things that I can do with my team there. So what are the things I wanted to throw out to you? I talked to lots of investors that are trying to find the answer, and they're unclear. We're all unclear about what the question is. I went out and sampled and tried all sorts of things. And so I've got to go back to Stephen Covey's begin with the end in mind. Why do this? Why go through all this stuff? It's easy to get 8% passive income with good security. That's what we pay investors, with just no muss, no fuss, and ACH transfer. But we have this idea, me included, that we can beat the market, that we are smarter than Bank of America, and we can out-collect lawyers who have tried to collect from these borrowers in years past. And sometimes we can, and I've had some just killer great deals. I bought a portfolio at 75, 76 cents on the dollar, performing portfolio. And I've had 3 payoffs in that portfolio at 100% in 2 years. And it's been great. But in the real estate game, the old rule is true. Everything takes twice as long and it costs twice as much. And if you plan accordingly, then you've got a chance to come out okay. I'm finding that more and more, this is a team sport, and I need to know my partners and who my contractors are and the track records of those folks, and do they really have the team behind them to produce. The market in LA changed dramatically, or the construction, hiring, and materials cost in LA and all of California changed remarkably with the fires that were up in Sonoma County and Lake and Napa counties. And the cost of lumber year over year is like 30% higher. And whenever you put together a pro forma for one of these jobs, you do not put in a 30% contingency for materials cost. But we've got to do something like that. It's really important to get the goals aligned and get them written down and signed in blood I've done handshake stuff, and some of the things I showed you are handshake stuff that if I had been firm and direct at the beginning and made sure we were all on the same page, we would have been out of these projects in a year. Plan for the worst. Like I said, the Bel Air house was running out of money, and it was well in the black in terms of equity. It was equity positive, but there was no way to go out and refinance a $4 million loan. So you have to be prepared to pay to get to the finish line. You got to be prepared for a capital call. And that's what gave us an opportunity to pick up another investor's position where he got a decent return. He got half of the expected return he thought he was going to get. But he got his cash out and he could go do something else with it. And again, I said spec deals go bad because there's no plan B. We were lucky to be liquid at the right time. We had a couple of things sell. We had cash in the bank, and we were able to jump on and double down on Bel Air. Really important to have actual real fund control in place. And I am very grateful to have Nick Curry on the other screen there taking care of all of that. That is nowhere close to a strength of mine. What I've been discovering doing work 50 miles away and having done now 9 projects 2,500 miles away in Florida is what is really in my control. I don't think I have any more control over what's an hour's drive from me than what takes me all day to get there. My job is not being the contractor or the supervisor or run into Home Depot to buy a whatever. My job is to manage from a step up and find deals. That's what my job's supposed to be. So if you think you're a passive investor, make sure you have somebody like Nick who's really active. Make sure that the contractor and the folks that are taking your money don't have 10 other projects going on and this is number 11. Make sure that what they're doing is the highest and most important thing that they're doing today. And then the variance in market. Those of us that live here in California just don't understand what the real world is like. We just don't. Being on the ground in Louisiana, where I'm in a fight with 6 heirs of an estate, I had to file about 1 lawsuit and sue 6 people to try to get 1 house back, and that fight goes on. And Ohio varies block by block, so that's the important thing to know there. And gosh, there's some local rules in Ohio that just make me make me shake my head. So real estate's a team sport. Find partners on this call. Find partners in your meetups and bigger pockets and conventions you go to that have common goals, that people that you feel like you could hand your wallet to and it'd be okay, but that have a complementary skill. If I was a great numbers guy, Nick and I would spend all of our time doing spreadsheets. But I am not a numbers guy. I think I'm a big picture guy, but that just means that I don't have the skills to be a numbers guy. And we're always looking for better projects than what we're working on. We're looking for to expand our team and our group of friends. I've been in the distressed, unsecured debt space for decades, and I have been so happy in this niche of notes and projects like this with the people that I've met, and this has really been just great for me. We really like to help problem solve. Nick and I, between us, have got 40 plus years of debt collection experience, and we like to help people look for other ways to get out of situations that they've gotten in. And the saying here in the office is we wouldn't come to work unless it was more fun than golf. So So let's see. I'm going to exit this. And somebody popped up. Oh, and Nick just popped up the, he put up the website for folks to look at if you want to look at the big project we got there. If folks want to raise their hand in the chat room, give us a question, we can field that. I went down my ladder from super big and beautiful to a very nice executive home to a good little bread and butter rental. And I have a horror story if you want me to put that up. If nobody asks any other questions, I'm gonna go put that up next. So let's just pause, and if anybody wants to weigh in and ask anything. Failing that, I'm gonna take a look a little bit at underwriting a deal. And I have a message. Where's the message? Oh, what does BPO mean? Oh, hi, Meryl. Oh, hi, Mary J. Sorry. BPO is broker price opinion, which is a half-baked appraisal. I don't put a whole lot of stock in them. You can get a BPO. You should always get a BPO whenever you buy a piece of property, or you should always go get a full appraisal and title report. But in the early stages, before you've executed, a broker price opinion will cost you $100. The big player in the space is a company called Clear Capital. But there's a hook in how to ask for that. When you ask for a broker price opinion, well, many notes and REOs that are sold will be sold with a broker price opinion. Often the broker price opinion is issued by the real estate agency that is handling the sale. So you're asking the seller to tell you the value of the property. The seller is not going to tell you a low value. The seller is going to tell you what Zillow tells you. And Zillow tells you what the highest price for the prettiest property in that zip plus 4 is going to be. Now, the property could be perfect on the inside. My experience is the interior home of the home looks about the same as the condition of the mortgage. If the mortgage hasn't been paid for 2 or 3 years, it's likely that the house hasn't been dusted, painted, cleaned, emptied of garbage, or anything in those 2-year period. A foreclosure I just took back in Cleveland had a roof leak on the second floor. No, it had a bathroom leak on the second floor above the kitchen. Waste had come through the kitchen ceiling and had corroded the ceiling and the lath and plaster, and it was bad. This woman was living in that condition, living with active human waste in her kitchen, right? If that woman had answered any of my phone calls, I would have redone her loan and lent her the money and fixed that in a heartbeat. I had bought that note at a significant discount, and I had room to go and make a win-win, right? So BPOs, when you buy, now I digress. When you do a BPO, make sure that you're asking for a cash or quick sale BPO. When you get a BPO from a company like Granite or Condor or any of the big broker houses, they will always give you a retail BPO because that's the highest price. And so, David, oh, hi, David. We've talked. Hi, how are you? So it sounds like we get a good many of our properties via note purchases. Do you find your note using services that report on pending foreclosures, or do you market directly to provincial private private carryback lenders? Also, do you target first or seconds? I came out of the debt collection space when I came back into working. And came back into really working. I never really retired, and so I didn't want to do seconds because that was entirely a collection play. I thought that I wanted to do firsts, which was an asset play, because I had spent years buying buckets of unpaid credit cards and payday loans and evictions and judgments and all that stuff. So finding deals is not, finding deals isn't as hard as you think. Let's pick up the phone, give me a call, or send me an email, and let's talk a little bit about that. And maybe we'll do a recording where we explore some ideas on how to source. Lots of folks have written good information on how to source deals, and we're experimenting with it. I've simply one of the quick little deals we did in Pensacola, we found by putting a for sale by owner sign out in the corner, and and another house in the neighborhood was available. So, let's see. And Jim says, I'm having problems getting any contractors to get a bid. Yeah, no kidding, right? Really good. So it's the same thing. Tenants always look like the property. Their credit always looks like the property. If you have a crappy property, you're going to have crappy tenants. You're also going to have a crappy property manager generally. I owned a property management business for 2 years. I was in the debt collection space for 30. So for 2 years, I owned a property management business. That was the worst job I ever had. It was so bad. You know, I had inventory of substandard condos in Palm Springs, and it was just awful. And finding contractors is tough. So how do you find a good contractor? You find you buy good properties. What do you do with bad properties that you want to move? You get good REO. You get good REO people that have people in the local market that'll pick up a project for you. It's to get a good contractor to do a $5,000 job. It doesn't exist. You've got to have the right local folks, and that's given them a listing or finding the right property manager. But as a former property manager, I'll tell you, we don't make any money at all. So we mark stuff up every chance we get because we got bills to pay. Wesley says, I suffer from ugly home syndrome, which means I view assets based on if I would live there. Did you have the issue earlier, or so what suggestion did you get over this? I've done some ugly house stuff. I've spent months and months and months having projects wait to get rehabbed and fixed. And I'm come of a mind that velocity is more important to me than gross overall margin. I'd rather make less money faster than big money slower. That said, here's the first deal we showed you. That's a big money deal, but that's the only one, right? That's the only one. Our bills are paid out of 30 mid-range mortgages and 1,000 unsecured loans. That's what this business runs on. So it's you've got to. There's the really good percentage money is in the cheap property. It's the really good percentage money is in the crap, but that's also where all the work is. And if I'm making a $10,000 profit on a $20,000 profit on a $20,000 purchase, that's a 50% ROI. But it's $10,000 and it took me all year. If I can find a better property and do a master lease and make $300 a month on a rent arbitrage, or if I can buy something that I can turn that will make me 17% instead of 50%, but it'll give me 17% in 6 months. Well, that's whatever that is. That's 34% annualized. We do a lot of lending in short term at typically 15% for 6 months. To put in seconds and thirds to move things along, and that seems to work. So we're a little bit of long term and a lot of velocity.
And Steve, just to add on to Jim's question about finding a good contractor, this goes back to the second example about property in Indiana and structuring the right deal with the right contractor who has the right incentive. You can create a win-win by incentivizing them to kind of co-invest with you. So you, of course, have the right opportunity where you can offer them a development project with upside, saying you are going to exit the property once the construction is complete anyway, giving them a share of the profits will dangle an extra carrot for them to bid a project and potentially put some really quality work into it that they might not otherwise do, and maybe then absorb and offset some of that cost for you, so that you can push some of that to the eventual sale of the property and really align your incentive with your contractor.
There's a Bigger Pockets book by Jay Scott about rehabbing and managing projects, and I've talked to Jay and listened to some of his podcast stuff, and I think he's an engineer turned flipper, and I think he's really got a handle on it. So we got other questions? We still have some time. Hi, Shelley.
Hi, how's it going?
Good. How are you?
I'm good, thanks. So I just got my first tape of notes today, and I started to look through it. It's an Excel spreadsheet, and I don't really even know what to do with it. So I was thinking, could we look at that together? And just go over it?
Cool. Here we go. I'm going to ask you to give me an address. And let me close this. Let me open another window.
Because I think I can just share my desktop. I'm
going to do something here, which will give you an idea of a way you can do this fast.
Okay, cool.
So let's see. Desktop. Let me get the right screen up. Hang on. Oops, too slow. There we go. Could you give me, if you've looked at the tape at all, give me an address of one of the properties that's of interest?
Okay, let's see. So I actually see the borrower's name, but I don't see addresses. So hold on.
Right. Well, you got to have addresses if you're looking at real estate.
Okay, hold on.
All right. Hang on, folks.
Hey, hold please. One moment, please.
I'm going to walk through with one that was a real loser.
No, okay, so that I think that was one of my questions. Like, oh, here we go. I'm ready.
Hang on, give me a sec. Let me get my screen. Let me get my screen shared because I'm no good at this software. I'll tell you. Okay. What's the address you've got?
4185 Tell Tell Road Southwest. Atlanta, Georgia. 30331.
Let's see. What do I know about Georgia? You have to be registered in Georgia as an entity to do a foreclosure, to go to court. It's a great state for bill collecting.
So where?
So you can't just say, hey, I'm from California. I want to take your house away. Georgia protects its citizens a little bit.
Okay.
So what I just did is I opened a little extension that the folks at Note MBA sell.
Okay.
It's a little $97 add-on that they have called Due Diligence Pro. And Chase Thompson over there has become a friend over the years. So let's see. So here we are. This is 4185 Tell. So I wonder, is it this?
Mm-hmm.
It might be. It could be this little house. the lovely thing about Google Maps and Google Earth is you can actually walk around the neighborhood.
Right.
This is pretty darn rural. What's the value? What are they looking for?
Okay, hold on. One moment, please.
Oh, we found a neighbor, not too far away.
Okay. They say that the loan amount is $30,373. The
Okay.
What?
And what are they asking for it?
Term rental. I don't know.
Okay. So here, so you look at Google.
Okay.
I like to look at Realty Track.
Okay.
You can look at foreclosure.com, whatever gives you an idea. You're in this neighborhood somewhere and you're looking at these prices you've got a foreclosure auction for 30,000. You've got everything all over the map here.
Okay. So at this moment, you're basically just comparing to see
you're looking
what
to see
what the average might be.
Real. Is it the median rent in that area is $525. That's pretty low.
Okay.
Yep, it's this little tiny house. It's 3-bed, 1 bath on a big lot, so it's on a 1/4 acre lot.
Okay.
I like that it's 3 beds. I have learned that I never want to buy anything that's 2-bed. I guess at this point, I want to buy 3 2s with big garages, so people move their stuff in and never leave.
Okay.
But this is, you got to decide what you're doing here.
It's telling me that the principal balance is only $1,524.
Okay.
And the P&I payment is $400.
All right. So in 2009, it went through the collapse, right? Went through the whole collapse. It was back in 2007 at the very peak of the market. Somebody cashed out and took a whole bunch of cash out of this thing, and it went from 45 to 19. Somebody bought this thing for $4,800 and then sold it 2 months later for $31,000. So this person bought this house, and this person you're collecting from, or would be collecting from, paid $31,000 for the house and has paid it down to $15,000. That tells me that maybe they want to stay. That could be. So I'm going to go close this, and I'm not big on country. I'm a city kid, so
Okay.
I'm backing up from here, and this doesn't seem like it's downtown Atlanta. This seems like it's here in the middle of nothing, but okay. You got all manner of stuff. I'm going to zoom in some more. Oops, I want that. Never mind, close that. I want to go zoom in. You use Zillow, and you want to go to look at listing types, only solds. And then you want to look in the solds, and this isn't the service to do it, but any of the services that shuffle title data, public record data, and you want to look for what cash sales are, right? So this is back to that question of BPOs. The house next door could have sold full retail for $200,000, but your house is potentially not structurally sound. We had this picture. Whoops. Let's see. Oh, and they go out and give me the Google map. So we had this picture. I've got this little cottagey thing. Oh, look, you've got a handicap ramp.
Right.
You've got a handicap ramp. That will tell you that the house has not been maintained because the person doesn't have the physical ability to keep up after it. So
Yep.
again, back to the question is it's gonna look like the mortgage, right?
Right.
But they held it for a while and they tried, right?
Right.
If there's an active public link to the county records,
Yep.
they will have that for you. This is the big thing that it saved for me, was being able, oh, there she is, being able to do this and not have to go Google search every county record, right? So this tells me what we have. We have a quarter-acre lot that they put a primary price on of the land of $8,900. See that there?
Yep.
Construction. This is a complete turnoff for me.
Because it's too old?
It will have knob and tube wiring. It'll have clay pipe to the street. It'll have a septic. So it'll have a failed septic system. It'll have illegal electricity. It will not be anywhere near local habitability code, right? So that's stuff that just makes me, just go, nope, nope, nope. But anyway, we'll just continue on. But some folks, for 15 grand, right? 15 grand, I don't know. It's owes 15, maybe they'll take 8. Maybe you can get it for half price. But what do we have? We have a transaction in 09. Stonecrest Investments sells it to Terrence Williams. Terrence Williams is your guy with the handicap ramp. And you can see that where it bounced around, right? That they had it sold in 07, and then they had it this, and they had it that. And U.S. Bank grants it to SB Hold. So U.S. Bank gets burned for the $100,000, right? And it gets handed off. So SB Holding gets it for $47.50. They sell it to Stonecrest they make $750, and Stonecrest makes $25,000. Okay, this is the game to be in. These are the people you want to be.
Right. So they probably bought it. Where? From the investment?
They bought it. They did not buy it from any of the marketplaces that you and I can get to.
Okay.
Right? They bought it through an FHA pool. They bought it out of some government surplus auction. They got it from Ocwen. They got, who knows who owned this thing, right?
Okay.
Wound up with them. Now back to what I do like. If you lived in Atlanta and you were a developer, it's zoned R3. You can put more than one unit on it. But you're not.
Oh. Yeah.
You're not a contractor in Atlanta, are you?
No, but I have some friends that might be, so I could connect with them.
If you have friends in Atlanta, somebody go drive by, and at that point, never ever talk to the people there unless you own the note, right?
Right. So then also just based on that information, so that whoever bought it for $4,500 then turned around and sold it to this guy, William Terrence,
then wrote a new mortgage
for a seller finance note, most likely, or a mortgage. Any
sort of intermediate non-bank bank kind of relationship.
Okay.
So he's got a homestead exemption at $23,000. I can't keep up on all the rules.
Yeah.
But what I think we just found is we have this information up here about what they keep as their valuation. I don't see, because he's got a homestead, he has like no property tax at all, $34.
Yep.
I don't see that. I'm looking for, can I find any unpaid taxes? And from there, you would have to go find the controller or tax collector department, the Treasury, to find out if there was, to find out what the tax situation was, because you're going to inherit the tax bill too. And that's one of the things that happens with all of these guys is they didn't pay the mortgage, they didn't pay the taxes.
Well, so in this particular case, I think he's current on this. So it's telling me that the principal balance is only $1,500. He's paying $400 a month, principal and interest, 0 taxes, 0 miscellaneous insurance, 0 T&I balance.
Okay, so that means that they're not escrowing taxes and insurance.
Okay.
So he's paying he likely does not have homeowners insurance because the place is only worth 20 grand. And he likely has not been paying his property taxes. And when you buy the property, when you buy the note and then attempt to foreclose, you're going to have to protect when you buy the note, you're going to have to protect your position and make sure that the taxes are paid. And
right.
we write tax checks. Well, our servicer writes tax payment checks for us all the time.
Right. Okay. And then the term says 113. So that's when
there's 113 months left to pay.
Left.
You need to learn how to use an HP 10B2 calculator.
Yes, I do know how. So that's cool.
To figure out if they've calculated the note process right. So you have to know how to use one of these.
Okay, and then what does REM turn?
Remaining term.
Oh, remaining term DB is -1.
I don't know. I don't know what that means.
Okay, cool.
So local sales. This county gives you some lovely local sale record. But again, I wouldn't touch this asset because it's too old. I'm going to close this, and I'm not going to close you to other than, we could do this all night and work this tape. But I want to look at another one. This is me dumping on Cleveland. So what I didn't like about that property was the age of the property. The condition's going to be, may not be habitable. And I didn't like that it was rural. I didn't like that it was rural, so I can't get good comps, and I don't have an active real estate market. When we looked on Zillow at sales, there was nothing on the map.
Right.
Right. So it's just you. I have had a handful of those. Some of them pay great. Most of them wind up just being, things I hang on to, things I'm hanging on to forever. I'm working on a foreclosure in Crystal, Michigan. I thought it was close enough to Lansing. No, it's not. No, it's not. Let's see. This is a turn of the century house in Cleveland.
Okay. Note
investor bought a delinquent mortgage. Let's say it's the same value. Say you get it for $8,000. Let's just pick a number, like around $8,000.
Okay.
Okay. I want to take a note that, they have a really big backyard. No, there was a house there.
Oh, no.
Now we're going to go walk around the neighborhood a little bit. We're okay here. We got some people living here. This also is a couple of years old. I got some dirt over here. And wait for it. Here's the neighbor.
Oh, no.
Okay. This, and we go down the block.
Industrial.
And I've got some sort of either dilapidated existing business. I got some commercial stuff down at the end of the street.
Yeah.
But anyway, so this is where you get in trouble, right? There's my boarded up neighbor. And here's our subject property. There was somebody living in this. It's now abandoned. It's full of trash. The investor can't get anybody to come clean it out. All right? This is probably one of those neighborhoods you don't walk around it.
Oh, wow.
So this is the kind of stuff that the giant investor firms that are selling to individual investors
Yep.
are putting out. And this is how you lose all of your money.
Right, because this is what this list is. It's their leftovers that they don't want.
Right. And this is what attracted this to the investor is this is a duplex. She thought this was going to be an income property.
Oh.
Okay. If something, yeah, it's too good to be true, unless you're a Cleveland contractor working in this neighborhood, and then you're picking up houses for like $500.
Yeah.
Right?
Yeah.
I know a guy in Gary buying houses from the city for $1,000 and putting $30,000 into them to make them habitable. He's a hero.
Just to clean up the neighborhood. Yeah.
He's a hero. And he's putting Section 8 renters in there. He's making 2% a month.
Nice.
But he runs a, I don't know how many employees. He's got 150 rentals in Gary. I mean, it's all he does 24/7. He doesn't do anything else. He has no time.
Yeah, that sounds horrible.
All right. So that's that.
Thank you.
Work your tape, learn the neighborhoods, look at assets that actually would be habitable, rentable, that have comps, that have an active real estate marketplace, and have some sort of economy nearby. I'm now only buying in states that have positive immigration, not emigration. Ohio is lost 40% of their population in the last 10 years or something. I can't fight that trend. But I can do business in Florida where the state population has increased 30%.
Okay.
So, all right. That's that story.
Cool. Thank you.
All right. So, all right. Let's see. If we have anybody else up, people are dropping off. Okay. Bye, David. Where do we find notes to buy? Again, there's too many. You can buy notes from me. I'll sell you performers. I'll sell you somebody who's actually paying you. Yeah. So, if you're going to learn the note business, I've been saying forever. Hi, Bev. I can see you.
Hi.
If you're going to learn the note business, I've been telling people forever, buy a performing loan, get paid to learn. Don't just throw money away thinking you're going to hit it rich the first time. There's a lot of steps in this process. So hi, what's your question?
Well, I want to find out how you hear good turnkey, bad turnkey. How do you find out which is which? And whether I'm buying something that I'm going to do value added or buying turnkey, I'm doing a 1031, and I just flew to Kansas City and Indy to check it out. But everybody's saying the inventory is so tight, and I'm worried I'm going to get down to the 1031, and that's not enough areas to check out. Do you think that I should expand to look at more than just those two areas to make sure I've got something to grab in those 45 days? I'm the only reason I'm not doing, flips is that I don't have time. I'm just buy to hold and cash flow at the moment. But we might try our first flipper. I own 5 rentals now, but they're all hodgepodge ridiculous. It's like, okay, now I actually want to buy something that makes money.
So are your rentals all concentrated in a particular area?
At the moment, no, they are all over the place. I got one on 40 acres that's going on the market in a couple of weeks. I've got another one up in Oregon that I listed 3 days ago for $340,000, and that will probably sell really soon. And so I'm trying to figure out exactly where I'm going to identify those properties really quick.
So have you figured out what you think you're going to be able to get? What's the model? What's the plan? Are you looking for a 1.5%, 2% a month rent multiple? Are you looking for long-term hold? Are you looking to turn people from rental to seller finance? Are you all this stuff?
Yeah. I'm looking at for the ones I'm selling, I'm offering owner will carry. For the ones that I'm buying, we're thinking hold, and we're thinking just so that we get away from not getting into a lot of maintenance, that, you know, once we fix it up or we buy it fixed up, that after 5 years we should move into something else, because that's when, I don't know, I'm curious what you think about that idea too.
Have you ever listened to or read anything written by John Schaub?
No.
Okay.
John
SCHAUB.
SCHOUB.
Yeah, AUB. John admonished me pretty recently. They basically told me that I was old and that I shouldn't be doing all this stuff that I'm doing, that I ought to own 10 or 15 houses outright and just go play golf.
Huh.
Nick and I have decided that I like to work more than I like to play golf.
Yeah.
And
I have a full-time business that's completely different than real estate, and a real estate license.
Yeah,
so
and this is
like going to add a third job, and I will explain.
And so, are you in most of the people on the call are in California? Are you in California?
Yep, Northern California.
Okay,
exactly why I'm looking Midwest, because you know, here I'm selling out here, but it makes no sense to buy here, and I'm in Sonoma County, so you know, trying to get a contractor has been a nightmare.
We're exploring doing a trade right now for a Rohnert Park house that rents at a good multiple. There's a whole bunch of nuance to the deal, but then one of the Jack Fullerton, who's another one of the old dogs teaching down here. And I'm in Orange County right now. Coach Jack says that he can ride his bike to all of his rentals. Jack's 80. Right?
One of my problems is that we've always managed them ourselves, and we want to be done with that. And I like the idea of, if it's far away, we won't be tempted to do that and fire the property manager and take over. All day yesterday, I picked up trash at my Cloverdale property. I'm so over that.
So when I get in the mood to market, I market to landlords, and basically my pitch is, I'll give you your price. I will absolutely give you your price, and I'll give up all of your headaches, and I'll give you the same cash flow. That's it. We're done.
Huh.
You know, I'll do everything else because I don't mind. You know, I don't mind. And I having run a property management company, having had, you know, and having partners in places, there's properties that fit for us where we'll take over the management. We do seller finance. You know, we do seller finance in both directions. You know,
okay.
We do seller finance both ways. We've traded some stuff. It's figuring out. It's what's the first job of a tenant. The first job of a tenant is to take care of your house.
Yes.
Right. And when you get into lower end stuff, they don't know that. Right. Right. But then you get, you know, we get sucked into the oh my God, I got a $50,000 house and I'm getting $1,000 a month. Well, yeah. And so I've been writing those to seller finance contracts to, you know, make the renter the homeowner. And I'm doing them on contracts for deeds, so that it's really like a lease. You know, they don't get the title until it's paid.
Now, what about percentages on that? I mean, I can go out and get a note buy a note and get 12%. So why would I give any, you know, Joe off the street a note for anything else? But why would they? I mean, they have to be pretty desperate to go that far up from what a conventional loan is, which of course they'd go to me if they couldn't get a conventional loan. But I mean, when you're doing a seller finance, you know, where like you're selling the place and they're taking a loan from you do you ask for 12%? Is that standard?
I don't. I take 10.
Okay.
I take 10 and down. I want people, you know, I want people to be able to see daylight. You know, I need to build incentive. I want you to know that you got 12 years, you got 15 years, and you're going to own it outright. Right?
Okay. So you do like 12 or 15, not 5.
If you ever get in trouble, you know, give it back. Don't no shame. No, just give it back. We'll help you move. We'll, you know, just whatever.
Cool.
And we've had that happen. I've centered into, even though Florida has a high property tax because there's no income tax. I've centered into Florida because I've got folks on the ground there. We're looking at other stuff. We're looking at bigger stuff in California. I own a piece of a mobile home park in Wisconsin. I own a piece of an apartment complex in outside of Microsoft in Seattle. And we're doing some things. We're doing more things local. We're looking to do some smaller multifamily in the North Bay.
My husband's very interested in that, and it's funny.
I split my time between Orange County and Novato.
Okay. Oh, in Nevada.
Yeah.
Okay.
So we're looking at stuff Northeast Bay, Fairfield, that kind of thing.
I mean, I haven't even. I looked around here a little bit, and I was like, okay, I was using the 1% rule on. There's just like, a 1/4%. So what's going on here? Yeah. So it's like, okay, go to the Midwest. But you're saying there is stuff in Rohnert Park?
And so there's lots of people selling the Midwest, people selling Memphis and Nashville. So you got to figure out where you want to be. And what I learned, I had a shopping center that I managed for 10 years in Denver. And I sold that, and I had this like knee jerk. I didn't want all my eggs in one basket. So I bought 33 mortgages in 12 states.
Oh, wow. Okay.
And,
yeah.
I should have maybe bought 12 single family houses or an apartment building or a mobile home park or something like that. But I rode the recession wave. I rode the crash wave and came out of it. And I was scared. I was reactive instead of thinking. I was reacting to, I didn't want to get myself into that pickle again.
Yeah.
And so what I did is I went back to full-time work and relaunched an unsecured lending business. But in the meantime, I built a really well-performing discounted mortgage pool, and that was okay. But I can do better. We're doing better. We're doing better with value add.
Yeah. Well, you mentioned where would I want to be? Well, it certainly wouldn't be the Midwest. I don't, it's like, I never thought I'd buy anything in Kansas City. I'm just trying to find somewhere where the numbers work to buy a rental, and it's like, and multi-unit is definitely, an option, but I haven't found anything local. So I figure I can only get to know so many markets. So I went on the ground in KC and I went on the ground in Indy. I found a good turnkey in Indy, but not so good in KC. Found a good contractor and an agent property management team in KC, but not in Indy. And so I sort of like, okay, well, I'll do one and one, and
and that's going down the thing that I was doing, where I got one here and one there and one there. And
right.
I'm going to tell you, don't do that.
Yeah, because it just splits the brain too far. It's
and you have no power with the property manager or the contractor because you're a one and done investor. You're not going to have anything to why are they going to jump through any hoops for you? You've spent your money. Right?
Maybe because I have a second house coming that I'm trying to list.
Yeah, but
I get a contractor.
If I were to redo it, I would have gone in and bought 4 someplace.
Okay.
And I also, and all the real estate, and up until the middle of last year, all the real estate deals that I had done in Florida, I've done 9. I did all out of pocket, all cash. I didn't start borrowing until I had done enough deals that I knew that I had the pieces together. But then markets change. I was building and selling houses inside of 5 months. And that changed when there was a hurricane. The price of lumber went up, and all the roofers went to Tampa because there was work there.
Yeah.
Right.
Yeah.
So you got all these different things you got to be able to figure out. But it's because we're local, and Nick's up there a lot too. We can kick around ideas. Yeah. So
that sounds good. Yes. I guess I'll just send you an email to connect on the phone then.
Yeah.
Okay.
Yeah.
That sounds good.
Yeah.
Thank you.
Okay. All right. So it's getting to be my bedtime. All right, so we're gonna wrap up. I want to thank everybody. We're gonna send out a link with to a Dropbox or recording for this. Invite you to share it with investor friends, and we're here to share and learn together. So I want to thank Nick for opening up for us. Thank you, Nick.
Thanks everyone for participating. We'll see you next month.
Okay. All right. We'll see you next month. All right. Bye, everybody.
Thank you. Bye.
Thanks. Bye-bye.